You are about to become an expert in a topic that very few people know about. Hi, I'm Megan Marsh of Keystone Alliance Mortgage, where we help homebuyers purchase homes, we help business owners buy buildings, and most importantly, we educate you about the mortgage and financing process. If you've ever wondered how much mortgage you could get approved for, how much you qualify for, this video is for you. And if you've never wondered how much you'd get qualified for because it seems like it's a pretty simple, straightforward answer, this video is for you. Income, learning and understanding the different types of income and how it's calculated in the mortgage process is unlike any other qualifying factor that goes on with things that you borrow. So there's lots of pieces to it. Today, I'm going to walk you through the different types of income and how it can affect how much you are qualified for when you're ready to go buy a home or refinance your home. So before we get started, and I'm going to walk you through the 7 different types of income and how it affects what you are qualified for. I get a lot of phone calls, our team gets a lot of phone calls where people are very confused why they are not qualifying for the house that they're hoping to buy, because let's say that their rent is $1,000, but yet they can only get qualified for $500 to purchase a home. It doesn't make sense. And my answer to you is that the mortgage industry, buying a house, it is very regulated. And even though we're going to go through these 7 types of income so that you understand how it affects what you get qualified for, there's a lot more to it than just the type of income. So keep in mind, if you're going to switch the type of income that you have, if it's going to change at all, how much you qualify for can also change very quickly. So let's dig in and understand the 7 types of income. The first type of income that is the easiest one to help people get qualified when they're purchasing a home is salaried income. Just your standard income that doesn't change. If you were to give and look at 5 different pay stubs, you're receiving the same amount in your paycheck every single week, week in and week out. And not only that, if you are hourly, which that is the second type of income that we're going to go over, hourly income also can be seen like salary. So if you are paid hourly, but every single week you have 40 hours on that paycheck of yours, it's treated just like salary income. The underwriters take the total amount that you make, they divide it by 12 months, and that's what's used when you're getting qualified to purchase, refinance your home. So 1 is salary, 2 is hourly. Let's dig a little bit further into hourly. So unlike the salary income, if you're hourly and your hours change on a weekly basis, so let's say you look at 5 pay stubs and one has 37 hours, one has 40 hours, one has 22 hours, well, no longer will that underwriter take your income and divide it by those 12 months. Now, if you're considered a variable income employee, and when you're a variable income employee, income is looked at over a 2-year period, which this can cause some frustration sometimes for some of you, because let's say you worked somewhere and you were only getting 25 to 30 hours in 2019, and now in 2020, you are working those 40 hours that you'd always wanted to work before. And not only that, you're getting overtime. Well, now when an underwriter is calculating your income, they're going to average what you're making in 20 with the year before. And that is always a little bit confusing and hard to understand for people who now are making a lot better money and they're hourly. So keep that in mind, and there are some ways around it, like getting a guarantee letter from your employer if they will now guarantee you 38 hours a week, every week. That is one way to get around it. The other thing with hourly, if you are paid hourly, there are some of you that work and you have what's called shift differential. Let's say you have weekend shifts and you get paid, instead of $20 an hour, you get $30 an hour on the weekend. Well, the same thing applies. The government has set all these rules and standards to where they feel safe to what people are going to get lent, and they want to see that you've received that shift differential for at least the last 2 years, and they're going to average it over that 2-year period. And then last but not least, some of you probably work jobs where, let's say it's a government job, for example. And let's say your hourly wage is typically $20 an hour, but when you work on a job that is paid by the government, you're getting paid $40 an hour. Unless you've received that government higher wage for 2 years, they're going to just use your base rate of $20 an hour. So it might seem like you should qualify for more, but it's because of these regulations that it kind of brings down the amounts that you qualify for. Then the third type of income is bonus income, and the fourth is commission income. Just like the hourly, the variable hourly, same thing happens with your bonus income and your commission income. The rules that are out there, which I do agree, some of them, I think they're just not thought through correctly, but they are the rules and we all have to follow them. But you have to be receiving bonus income and commission income for a 2-year period for it to be averaged. There are some little rules around it, but if you switch jobs and let's say you are working at a car dealership and you are getting commissions, and then you leave that car dealership that you've been at for a few years and you go take a job, let's say in pharmaceutical sales. And now you're getting a salary and bonus. You cannot count that bonus income until you've been at that new job for 2 years. And even if you switch to a different dealership and you're getting paid commission again, they will allow it, but you got to be there a year before they'll start using all these extra pieces of income that are wonderful for your family, but it's not wonderful for you when you're qualifying until some time has passed. I remember when I first started in the mortgage industry and I worked as a W-2 salaried employee, and I'd been there for a year. And the next year I went and started to do mortgages and selling, and I started getting commissions. And we went and bought a home, and I could not be on the loan. I had been at this employer for 2 years, but because I went from a salary employee to a commission-based employee, they could not use my income until I had 2 years of that commission. So it doesn't just happen when you're buying, it happens when you work in the industry too. The fifth type of income, probably one of the most complicated types of income out there, is for those of you who are self-employed or you're 1099. So you work for yourself. Your taxes do not come out of your paychecks. So 1099 employees, that's like your real estate agents, your financial advisors. It also is for your self-employed as if you have a business that's incorporated. And if you have a business that's incorporated, even if you're paying yourself a W-2, there are other rules around getting qualified. And it's probably one of the most challenging areas. And it's the buyers that we see the most and that we help the most, because if you are self-employed, depending on how long your business has been open, if you're profitable, how profitable you were the year before and the year that we're looking at right now, it can really affect how much you are able to borrow when it comes to banking and all the regulations. We're going to do a separate video for self-employed borrowers to try to dig in a little bit deeper to help you understand. The key for you, if you're self-employed, if you're 1099, is to work with a loan officer who is experienced working with self-employed borrowers. And I always say, looking for someone who is self-employed themselves, because then they're going to understand what you're going through and what you do for your business and for how you pay yourself. And then income type number 6 is going to be those of you who are retired. So if you're retired, your income starts to change. And so you start getting into, are you receiving Social Security? Are you receiving a pension from a job that you worked at before? Do you get IRA distributions? So there's all these other types of income. And it's kind of a tricky thing because you're switching over to being retired and receiving these income. The key to it is that the underwriter needs to make sure that this income that you're now receiving is guaranteed, that you're going to get it for at least the next 3 years. So because of that, your Social Security is a guaranteed thing. Those IRA distributions that you can now take, you have to be receiving them for 2 years. But there is a little trick that you can do, and there is a loophole in the system. If you have a big enough size retirement account, you can actually start taking consistent checks and getting a letter from your financial advisor. And as long as the equation that underwriters use, that they can prove you're going to have that income for the next 3 years, you can use that and you can qualify for a mortgage by just receiving 2 checks once a month, 2 months in a row, and then use that income. And so my best piece of advice for you, for all of you who are retired and enjoying life, is to reach out to a loan officer and talk through with them the best way you can set yourself up to be able to purchase, refinance, and do the things that you want to do so you can enjoy your retirement. And then number 7, I kind of did like a catch-all, a miscellaneous bucket, because there still is a lot of other types of income out there. And this miscellaneous income that I see most often would be your child support and your alimony. It would be interest income. Let's say you have a big portfolio, you have millions of dollars in an account that you receive interest on. Those types of incomes can be used, but there are rules around them. So for child support and alimony, just like everybody else, they want to make sure that you're going to be receiving it for at least 3 years. So if you have, let's say, a child who is 11 years old and you have a child who's 17, and that child support is going to be received until they're 18, that's why your loan officer or the processor that works with them is going to ask for your kids' birth certificates. They want to see that you're going to be receiving it, and then they're going to want to see that you have been receiving it so that you have someone in your life who is paying that child support to you for when you're going to buy a house, so that they know you're getting it and you're going to continue to get it when you move you and your family into a home. The interest income, they're just going to look at a 2-year average, but you can use that income. And then the last bucket in that miscellaneous bucket there is rental income. What about having properties that you receive rental income on, that you have leases for, that are rented out? Or what about if you want to rent out the house that you're currently living in to go buy another one? We are also going to create another video for this very specific topic, but you can use rental income to qualify. But it does have a lot of rules around it. Make sure that you subscribe to the channel so that you get notifications when we continue to update you on how the income's calculated and how your decisions on your jobs are affecting you buying a house. So also, you can find us on Instagram and you can find us on Facebook, and we're always making sure that we're putting out content that helps you move forward and become a homeowner or buy a building for your business. And also, don't forget, there's a link in the description that you can go and click and go to our website and speak to one of our loan officers about purchasing a home and how your income will affect the whole process.